Nick, so good to see you. We are getting back to basics today with RMD 101, the rules that catch retirees off guard. Required minimum distributions aren't just about taking money out, they come with specific IRS rules that affect how, when, and where those dollars can be spent. Understanding these basics can help you avoid penalties, manage taxes, and even support your favorite charity. So let's start with number one. Each account is separate. The IRS requires you to calculate the RMD from each of your pre-tax retirement accounts individually. How does this rule catch people off guard?
Right. So you want to go out and you want to calculate each of these accounts, and most custodians are going to send you all of that information. So it's not something that you have to go out and do the calculation, but gather up all of those IRA accounts, and then start to total them up. Now, where it catches people off guard is there's a difference between IRA accounts or employer sponsored IRA accounts, so 401ks and 403bs and so forth. So you want to be very careful of the rules, because when this money gets taken out of each of those accounts, you can take individual IRAs, you can look at all of those as one, take it all out of one IRA, take it proportionally out of each of those IRAs. But when you get into the employer side, now you want to make sure that you're taking it out of those accounts separately from what your individual retirement accounts are, because the IRS, it's kind of like two different departments. You got your individual side and your employer side, and it's like two siblings that just don't want to talk to each other. And at that point in time, if we take all the distributions from a 401k, that's not going to satisfy that RMD for those individual retirement accounts.
Right.
So be very careful of this.
Yeah, I can see why that's confusing. Number two, you cannot use your RMDs to directly contribute to a Roth IRA. Why is that?
Yeah, so to contribute to a Roth IRA or even a traditional IRA, you need to have earned income. Okay, so we can't take that RMD and contribute it directly to the Roth IRA. Essentially, we pull that money out, it goes into a non-qualified. If you do have the earnings to be able to make a contribution, we could at that point in time, make the contribution to the Roth IRA, but we have to have the earned income to be able to do so. We also cannot do a Roth contribution, from these funds either, because that first step, the IRS wants us to take that money from qualified assets and move it over to the non-qualified side first. So we can't do the conversion with it either.
Okay. Number three, using an RMD, though, for other expenses is okay. Once the RMD is taken, the cash is yours to use however you wish. Now, does that include reinvesting it in a taxable account?
Absolutely. Once we take it out of the IRA, bring it over to that non-qualified individual or joint account, we can spend it, save it, reinvest it, gift it, do whatever you want with those monies at that point in time. The IRS just wants their tax dollars first on that.
Okay.
So.
Now, you mentioned gifting it. This is my favorite. You can use your RMDs for charitable donations. Explain how this strategy works, please.
Yep, absolutely. So there's two different forms of gifting that I'm talking about with this. There's gifting to family members, and then there's gifting to qualified charities, and they're both taxed differently. So if we do a distribution to a charity, a qualified charitable distribution, and that money goes directly from your IRA to a qualified charity after you're age 70 and a half. So if you're taking RMD money, you're over that age. But at age 70 and a half, we can start this qualified charitable distribution, and the IRS does not count that towards your taxable income. So taking it directly from the IRA over to a qualified charity, not your kids or grandkids or anything like that. But it goes to that qualified charity. At that point in time, it's removed from your taxable income on your 1040.
Yeah, that's a really big deal. So another way to say it, if you're putting money in the collection plate at church, there is a more tax efficient way to do it that still helps everybody.
Yep, absolutely.
Number five here, Nick, I feel like people probably know this already, but it bears repeating because it is important. RMDs are taxable.
Yep, absolutely. So it depends on what your tax bracket is, from there, how taxable they're actually going to be. But they are brought out. You will get a 1099 at the end of the year to show you what that distribution has been, and it will be, reportable onto your 1040 at that point in time. And then depending on whatever your tax rate's going to be, determines how much you're going to be paying Uncle Sam.
Right. Now, we did want to remind everybody, though, that those Roth accounts do not have RMDs.
Absolutely. So any sort of distribution from there misses as long as you hit the qualifying rules, that misses the 1040, that's tax-free income to you.
Yeah, interesting. A lot of moving parts here. Again, Nick, I really enjoy when we get a chance to go back to basics and talk this through, because RMDs often are pushing people or keeping people even in the same bracket when they're retired. A lot of people assume they're going to be in a lower tax bracket when they retire. That's not often the case unless you start with some proactive planning. So if somebody would like to talk to you about RMD strategies, how to lower their taxes in retirement, what's the best way to reach you?
Yeah, they can reach out to us online at EWG Retire. There's a schedule link right there, or give us a call, 937-498-1128. We'd be happy to set up an appointment and discuss this with you.
Great. Nick, thank you.
Thanks, Aaron.